Today, we want to talk about the investment criteria used to evaluate projects. Suppose you have a budget and you will propose a dozen different projects. So how do you pick the good ones to invest? So our goal today is introduce you 4 different criteria or decision rules, namely NPV rules, Payback, Profitability Index, IRR. So a good decision rule will help us separate bad investment from the good ones. So they are able to address the issues such as, do you consider the time value of money, the timing of your receive $1,000? Doesn't matter you receive at year 1 or year 3. Do you consider the risk of the project, safer versus risky investment? Do you provide information, say, how much money you can add it to this from this investment? So we're going to go over one by one. We're going to introduce how we apply these rules, how we calculate these measures, and through examples. The first one is net present value, NPV. So this is one of the most popular, most widely used decision rule. If you don't remember other ones, just pick this one. So how do we figure out net present value? NPV is calculated between PV of future cash flow and the initial cost, initial investment. So we're going to accept if it's a positive NPV, reject the project if it's negative. So you can use the formula. Find a PV of each year future cash flow plus initial outflow. Or you can use financial calculator. Let's take a look at this one example. Initial time 0, you spend $165,000. Then you're going to receive 3 positive cash flows. Discount is 12%. If we go with the formula, we're going to discount all each future cash flow one by one. First year cash flow, second year cash flow, third year cash flow, plus initial outflow. Then the NPV is positive, which means our recommendation is go ahead, accept this project. So how do we figure it out? Use cash flow keys. Use financial calculator, you press cash flow keys. You're going to set up the initial cash entries. Remember, the frequency means how many times you repeat the cash flows. Then we press NPV, enter the discount rate. Lastly, press NPV and compute. Again, we got same number. Take a pause and practice this NPV before you move on to next. The second decision rule is called Payback Rule. Payback Rule is old, classic, traditional. So payback period is the number of the time period required to recover your initial investment. So you can simply just add up all the positive cash inflows until you recover the initial spending. There's 2 different ways to figure out the payback period. Depends on assumption of the cash flow. We may have 2 ways to figure out the payback period. If we assume cash flow is continuous, for example, you're going to receive $365 next year. If we assume cash flow occur evenly, continuously, then you probably get about $1 per day. If we assume instead the end of year cash flows, then you may get $365 in one paycheck at the end of December 31st. So how do we apply decision rule once we figure out the payback period? For example, they require 2 years or 3 years or 4 years to recover your initial investment. So we need to compare a pre-specified cutoff period decided by the company. Each company may pick a different one. So if your payback period is less than cutoff period, means you recover earlier than required period. So you're good. You're going to accept the project. Let me show you one example. So we will still go back to the same examples, same cash flow. The company will accept if the payback is 2-year period. So to figure the payback period, let's first create a balance column. So the balance is simply calculated based on the previous balance add the cash flow coming this year. So initially start with 165,000 spending. 1 year later, we total recovered 63,120. So the balance improved to negative 101,880. So on and so forth. So we will see balance change from negative finally to the positive. Assume the cash flow occur continuously and evenly. So we want to figure out how long does it take to recover the initial 165,000 spending. So first step, you're going to create a balance. Second, we figure out when it's time our cash flow balance change from negative to positive. So this is between 2 and 3. So lastly, we figured out by the end of year 2, we still own $31,080 to recover. And year 3, the total amount cash flow coming in is $91,080. So this gives us the payback period calculation. So 2 years plus about 0.34. So do you understand the procedure? 1, balance. 2, look at the change of balance sign. 3, figure out the exactly a fraction of the period you need to recover in the end. So if the payback is 2.34 years, which actually is greater than the 2 years which is required by the company. So it's too late. We have to reject. So let's assume cash flow occur evenly. So if we assume cash flow occur only at the end of the year, it is much easier. It requires at least 3 years to recover. So I want you to test your knowledge. Are you ready? So assume cash flow occur evenly. Show me if you can verify the payback is 4.1. As I mentioned, payback is old classic. You don't need a fancy financial calculator to do this. So it's easy to calculate, easy to understand. In addition, it is really appreciated liquidity. If you are the company really short of cash, short of capital, so you may want get investment back ASAP. So the payback is a good way to really consider that. But you probably noticed a few issues. Number 1, we simply add those cash flow. We do not really care if you receive this $1,000 at year 1 or year 2 or year 3. Number 2, no control of the risk or adjust for risk difference. Number 3, we ignored all the cash flow after payback period. Right? Even you have a big amount, maybe later in year 10, we already ignore that. Lastly, no explanations why it's 2 year or 3 year selected by the company. The third decision rule I'm going to talk about is Profitability Index, in short, PI. So this one is close to the NPV decision rule we mentioned. In the NPV, we use PV of future cash flow, subtract initial cost. In the Profitability Index, we use PV of future cash flow divided by initial cost. So compared to NPV, when we were comparing, NPV is positive and negative, which means compare with 0. So PI is a ratio. We instead compare to the 1. Right? So once we got a profit index, for example, 1.5, means every $1 we invested, we are able to receive $1.50 in the future. Go back to our same example. So how do we figure out the PI? You can use formula very similar. Solve PV first, then divide by initial cost. We got 1.077. It's greater than 1, we're going to accept project. If we use cash flow keys, the only difference compared to NPV is, as we are looking for PV only, not net present value. So we want to leave the cash flow 0, initial cash flow 0. So leave out. Don't enter the initial outflow for now. So we go through the same procedure and compute NPV, which essentially is PV in this case. So lastly, you have to do one more calculation. Use the NPV we got and divide by initial outflow. Again, we verify the same 1.077. Does it make sense? Let me see. I want to pause and check, practice this example. PI is very close to NPV, so it shares the common features of net present value, which is consider the risk and time value money, give us normally same recommendation. One issue we might run into is when you're ranking project, PI does not always give us correct answer. Suppose we have 4 projects. So we have initial cost, we have the PV of the future cash flow. So based on these 2 columns, either subtract or divide, we can get information on net present value or PI. So let's take a look. According to PI, which project has highest PI? C, right? So according to net present value, which project has highest net present value? D, right? So now we have a different ranking. Which one's correct? Right. So NPV is correct. So why PI rank project C higher than D? In other words, why NPV rank D higher than C? So one thing PI tend to ignore is the size or scale of the investment. Think about this. If we talk about $100 investment versus a $1 million investment, right? So it matters. Even your per dollar basis has higher, maybe it's only very small project. So this explains exactly why D is better, because D is double in size in project, and so total amount in NPV actually is higher. The last decision rule I'm going to introduce you is internal rate of return. It's called IRR. This is by far the second popular decision rule. It's used widely in practice. IRR is a discount rate or interest rate, which will make NPV break even. So we're going to compare IRR with a pre-specified required rate of return. If it's greater, then we accept. So how do we understand IRR, required rate of return? They both express in the percentage. Okay, IRR is discount rate. It is determined purely by the cash inflow, outflow of this project, while required rate return is a discount rate based on the risk of this project. So this slide shows you that the procedures to understand or calculate IRR. basically its discount rate make NPV break even. However, it's very difficult to calculate if you use trial and error process. There's no way you can use one-step calculation. Let's take a look at one example. You have the investment purchase a building today, $350,000, would generate cash flow $16,000 in the next 3 years. In the end, you receive $450 from selling the building. So I would recommend use cash flow keys. Okay, formula is only for illustration purpose, not actual calculation. So set up cash flow keys, then you're going to press IRR compute. So we notice the rate of return is 12.96, means if you do this 3-year investment every year, you get a return about 12.96%. Pause a moment, practice, find out IRR for this investment. Did you get the answer correct? IRR is very, very popular and share a lot of common features as NPV. But there are two situations you have to pay attention to. IRR may have mistake. Number one, when you're ranking project. Number two, when we deal in non-conventional cash flows. So what do we mean by non-conventional cash flows? So typically, when the cash flow of the project changes sign more than once. So typically you have investment, initially time 0, you spend money, set up, outflow. Then you're going to receive all future cash inflows. So this is the conventional. So the non-conventional is instead of initial investment, you may have additional outflow, additional spending later on in the life. Could be expansion project. So this one is the one we mentioned, non-conventional cash flow. Let's see these examples. So use cash flow keys financial calculator. We found out IRR 10.11. Compare the quality return. We say, it's lower, so let's reject. But it's really so, because this project is non-conventional cash flow type. Initially, time 0, you spend negative. You spend $90,000. And time 3, you have another spending of $150,000. So this could have issues. What is the problem? Take a look. So when we change the discount rate and find the NPV, we will notice that the NPV will hit the horizon twice. So this implies by the definition we have two IRR. One is 10.11, the one found by the financial calculator. Another one is 42.6. So non-conventional cash flow, you might have more than one IRRs. So what we're going to do, use NPV decision rules instead. Another situation IRR may make mistake is ranking, when ranking the mutually exclusive projects. So which means you have only limited budget. You have $20 million, you are able to spend $20 million. That's it. So you cannot pick every project if you wish. Same thing like you come to the school, study, you cannot go to full-time job. So in the mutually exclusive project, the decision rule of IRR PI may have the problem, namely when the size of the project, the scale of the project were different from each other. For example, you talk about a project of $100 versus a project of $1 million. Even IRR is very high, PI very high in small project, does not necessarily guarantee the total money is greater. Example, A and B, they are mutually exclusive project. You only pick one, not both. Okay, so IRR said, oh, B is better. But look at the NPV, see A is better, right? So in this case, always go with NPV decision rule. So pick A. So why B is ranked higher? Smaller project. So in summary, when we have different conclusion using NPV or IRR, always go with NPV. Be careful when you use IRR decision rule for non-conventional cash flows or mutually exclusive projects. So lastly, I want to really show you a technique. So this is NPV profile displayed the NPV of a project at different discount rate. As you see, each line is a downward sloping. Now the two projects, they cross over at one point, which means this discount rate will make both have same NPV. But how do I find out this amount? Let me show you. So your job is create additional column, and the column you treat as a new project. This is based on the difference between A and B. So you do the cash flow for every single year. Treat it as a new project. Then what's next? Simply find IRR. That's it. Okay, so that's the IRR 14.33 is the one both A and B has same amount net present value. So I want to pause and practice. It's very useful technique. In summary, so this lecture went over 4 decision rules. So you need to understand how to calculate measures by each decision rules, how to apply decision rules, understand pros and cons of using each of them, pay attention to the pitfalls when you use PI and IRR decision rules. So that concludes our lecture today.